The collateral requirements for surety bonds can be a bit confusing, and oftentimes insurance agents find it difficult to explain these requirements to their customers. That's why in this video, we're going to give agents like yourself a comprehensive guide explaining why surety companies require collateral, when do surety companies require collateral, and what types of collateral do surety companies accept. Surety companies require collateral to offset their level of exposure in the event a valid claim is filed against their bond. This is the part that generally trips up most insurance agents who are used to dealing in more traditional lines of insurance, such as home and auto. But to better grasp this concept, agents need to adjust their perceptions of what exactly surety bonds are. Surety bonds are essentially a line of credit extended to your customer by the surety company to ensure that the obligee does not suffer financial harm if your customer violates the bond provisions. Additionally, surety bonds are subject to indemnification, meaning that the principal or your customer is legally required to repay the surety company for all claims and claims handling expenses. So now that we know that surety bonds are essentially a line of credit that are subject to indemnification, it makes more sense that surety companies would require collateral to protect themselves from losses sustained as a result of bond claims. So now that we know why surety companies require collateral, when exactly do they do so? Surety companies very rarely require collateral and will typically only do so for non standard lines and for judicial bonds. To add a bit of context, non standard line is a term used to describe principals who are considered too risky to qualify for standard premium rates. Simply put, if your customer is considered high risk by the surety company or is applying for a judicial bond, then they may need to put up collateral in order to obtain bond coverage. So, what types of collateral do surety companies accept? The most common form of collateral used in the surety industry is cash. To submit their cash collateral, your customer simply needs to present the surety company with a cashier's check or conduct a wire transfer. Surety companies will also accept a letter of credit as collateral, which is essentially a promissory note backed by a financial institution that guarantees the surety company will receive payment if any claims are made against the bond. So, how can an insurance agent obtain a surety bond for their customer? Bond exchange makes obtaining a surety bond easy. Insurance agents need to simply log into their account and search our database to find their bond. Don't have a login? Enroll now by going to bondexchange.com and clicking on that big blue Get a Login button, and let us help you satisfy your customers' needs.